Hi, I'm licensed Nevada credit services provider Damian Falcone. This is part 1 of the credit reporting video series. In this series, we'll talk about creditworthiness, the underlying components of a credit score, commonly referred to as credit scorecards, what you can do to develop and strengthen these components, and some of the benefits that go along with creditworthiness.
This is part 1, and we will focus on the basics of credit scoring models and credit scorecards. In part 2, we will go into more detail on some of the major components. This is Get Repaired, your source for personal credit management information. Credit is a core element of financial success, whether you are talking about business or personally. It is not uncommon for consumer finances to follow and learn from the examples set by Fortune 500 companies or large corporations. If you don't know much about credit or credit scoring models, don't feel bad. In the early 1980s, small and mid-sized banks were just beginning to implement database-driven credit scoring models in their financial management plans. That means, in many ways, they were operating along the same lines as pawn shops. Credit debt management will likely become an obvious part of the consumer portfolio. Similar to the attention given to personal asset management in the early 1980s by people like Charles Schwab. Due to the decades of research performed in the corporate sector, we will make references at times relating consumers and corporations. For our explanations of credit, we will use the 5 C's. The 5 C's are character, or desire to pay, capacity, ability to pay, capital, general financial condition, collateral, asset pledged to security, or conditions, economic trends that may impact payment. We use the 5 C's because they are a more tangible representation of the components that are commonly referred to as credit scorecards, which institutions from pawn shops to the world's largest banks use to empirically evaluate creditworthiness, from who to attract as a potential client, all the way to calculating how much they are likely to recover from a collection account. You may have seen a list of the components used to calculate a FICO credit score. The FICO score is becoming increasingly less important due to the availability and affordability of complex computer software, which has motivated many smaller and medium-sized institutions to develop their own scoring models in-house. We will use these models to answer the questions: if I have a FICO score of 730, why is the bank telling me I'm not creditworthy? What do I need to do in order for a bank to want to give me money? How can I look better on paper or financially responsible? Scoring models use calculations called algorithms to predict creditworthiness. These calculations are only as good as the information they are based on. So if there is incorrect information in your credit report, it is likely to misrepresent you. Also, no prediction is 100% accurate. This is why bank vice presidents, among others, know how to evaluate the components of a credit score using the 5 C's. So keep in mind, if you feel like you're out in the cold, warming up is only a few good steps away. I'm Damian Falcone, and this is Get Repaired.